Have you ever watched the markets and just wondered, how can a single number, one economic report, create or wipe out fortunes in your stock portfolio or your Bitcoin holdings in just a few minutes? Well, that's exactly what we're going to break down today. It's a question that can drive you crazy, right? Why does the entire financial world seem to hold its breath and then explode with activity over what's basically just one number? What is going on there? Well, the secret is that it's not a direct hit. It's not like the inflation number itself is pulling a lever on the stock market. Think of it more like a chain reaction. That number, it's just the first domino to fall. And here it is. This is the roadmap we're going to unpack. It all kicks off with inflation. That inflation report then triggers a reaction from the Federal Reserve. And that policy change, that's what ultimately sends shockwaves through the markets. So let's dive into that very first domino. All right, first things first, let's talk about this signal itself, inflation. This is ground zero for the whole process. So what are we really talking about here? In simple terms, inflation is just the speed at which prices for everything, from your groceries to your gas, are going up. And as they go up, every single dollar you have buys a little bit less. Your purchasing power, it starts to shrink. Now, the Federal Reserve and all the big market players, they don't just go by a gut feeling that prices are rising. No, they are laser-focused on very specific signals. The big ones you'll always hear about are the CPI, or Consumer Price Index. Then there's Core CPI, which is really important because it strips out the super volatile food and energy prices. And finally, the PCE, or Personal Consumption Expenditures. These are the numbers that really, truly matter.
Okay, so this brings us to the real star of the show. The main character in this entire economic drama, the Federal Reserve.
And here is probably the single most important idea to get your head around. Markets are always looking ahead. They're not just reacting to today's inflation number. They are reacting to what that number forces the Fed to do tomorrow. It's a game of anticipating the Fed's next move. And really, the Fed finds itself at a fork in the road. It has two main tools, two main paths it can take. If inflation is running way too hot, they tighten policy. That means they raise interest rates to try and cool the economy down. But if inflation is low or falling, they've got room to ease up, to cut interest rates and give the economy a boost. It's this simple choice that has the entire market on the edge of its seat. So we have the signal, and we have the reaction from the Fed. Now let's trace that first ripple as it spreads out and hits the stock market. When the Fed starts tightening the screws and raising rates, it can be pretty rough for stocks, especially for those high-flying growth and tech companies. Why? Well, for one, it gets more expensive for them to borrow money to grow and expand. Also, higher rates can slow down consumer spending, which hurts sales. And here's the really big one for investors. All of those amazing profits a company's expected to make years from now, they suddenly become worth less in today's dollars. So the key takeaway here is huge. The overall direction of the stock market often has a lot less to do with the inflation number itself and everything to do with how traders expect the Fed is going to react to it. Okay, let's switch gears and talk about Bitcoin, because there's a really popular story out there about what Bitcoin is and what it does. And, well, we're about to poke a few holes in it. I'm sure you've heard this a million times, right? The story goes that Bitcoin is an inflation hedge, that it's like digital gold, a safe place to protect your wealth when the value of the dollar is going down. It sounds good in theory, but is that what actually happens in the real world? Does the data back it up? Yeah, not so much. In reality, Bitcoin behaves a lot more like what we'd call a liquidity-sensitive risk asset. What does that mean? It means it does really, really well when money is cheap and easy to get, and it tends to struggle when money gets tight. And this chart just lays it all out perfectly. The blue bars there, that's the growth in the money supply. You can just think of it as liquidity. And the yellow line, that's Bitcoin's price. I mean, you don't have to be a data scientist to see it. The periods where those blue bars are high, when liquidity is expanding, they line up almost perfectly with those massive bull runs in Bitcoin. It's a story about liquidity, not a direct hedge against inflation. Okay, so with all this in mind, how can you actually use this information? Let's try and put together a kind of strategic playbook for investors. The really smart investors, they aren't just staring at that one big CPI number every month. No way. They're looking at a whole dashboard. They're watching the trends in inflation from month to month. They're watching what bond yields are doing. They're looking at what the market is predicting for future rate cuts. And maybe most important of all, they are hanging on every single word of guidance from the Fed itself. They're trying to get a complete picture of liquidity.
All right, let's put it all together one last time. This is the mental model, the framework you should walk away with. It starts with the inflation signal. That signal prompts a reaction from the Federal Reserve. Their policy decision then changes the liquidity conditions, how much money is flowing around. And that is the mechanism that ultimately drives the performance of risk assets like stocks and Bitcoin.
So at the end of the day, what's the big takeaway? It's this. Inflation is not just an economic statistic. It is a signal that shapes liquidity, that drives Bitcoin and U.S. stock performance. Once you understand that chain reaction, you can start to see the market more strategically, not just emotionally. And the real question is, now that you can see how the dominoes fall, which one will you be watching next?